How do I think about valuation multiples as it relates to my investment process? That's a question that I got from you guys, which I'm going to cover in this video. So guys, as you smash that like button, let me run that intro. What's up everyone, and welcome back to the Q&A series. Here's where I try and pick out some of the most commonly asked questions and answer them in this series. And the question that I'm going to answer in this video is, how do you think about valuation multiples, i.e. the price to earnings multiple, the price to book multiple, the PEG ratio, in my investment process? Because I haven't really spent a lot of time talking about these, and hopefully by the end of this video, you guys will understand better why I don't really talk about these too much. So I'll start with the first comment, and this is going to be on every slide, which is ratios are only the beginning and not the end. And the problem here is that a lot of people will start and end their investment journey by looking at the ratios. And so what they'll do is they'll look at the description of the company. Do they understand the company? Yeah. Then they'll look at the ratios and just say, you know, high level, is it cheap on a ratio level? And if it is, then, you know, they understand the company, they understand that it's cheap, and then they'll buy the security. The problem with that is that you open yourself up to a lot of problems because, one, you really didn't understand the company as detailed as you probably should if you're going to be an owner of the business. And two, you may not necessarily have considered any of sort of like the short-term impacts or any sort of like the issues that might be hiding in the numbers. And so that's why I always encourage everyone to build out models on any company that you're looking at. And so essentially what I'm trying to say is that when I'm looking at companies, ratios are something that I look at the beginning, but it only starts my research process. It's not the end. And so when it comes to the price to earnings ratio, the first question that I like to ask with this particular ratio, if I'll look at it before I start looking at the company, and this is the most commonly looked at ratio that I do look at. And the question I'll ask is, you know, if I see a low price to earnings ratio, I'll say, are the earnings sustainable? Because here's where you guys can run into a problem. Oftentimes, low PE ratios could be signaling that the earnings are about to fall. And this is what's referred to as a value trap. So be very careful with that. Like, for example, you know, in times where, you know, the oil price is going sky high, you might actually have low price to earnings ratios for oil companies because the market is just expecting that the oil price being sky high may not necessarily be sustainable. Another situation is if the bank or the central bank is increasing interest rates, you could actually have banks trading at very low price to earnings ratios. But the reason for that is because the market is expecting that the loans and all of that stuff is going to come off. It's going to come down. And so the earnings for these banks are going to come down considerably as a result of fewer people requiring banking products like financing products. And so there's just going to be fewer loans being put out. And so, of course, the banking's earnings are going to come down. And so right now they look like they're trading cheaply, and the banks will argue that they make more money in a high interest rate environment. And that is true to an extent, but they definitely put out more loans in a lower interest rate environment. And I would argue that they make more money in a lower interest rate environment. And so for that reason, you know, you could potentially have a value trap with even banks in that environment. Another one is just cyclicals, right? When you're at the top of the cycle, and this is probably the best example, at the top of the cycle, you'll have, you know, consumer discretionary type product companies trading at very low price earnings multiples, and you think that they're cheap, but then you really have to ask yourself, and here's where it comes to modeling out the company, is are the exceptional levels of or amounts of growth rates that you saw in the past 5 or 10 years, are they going to be sustainable over the long term? And if they're not, then you got to ask yourself, what is the reasonable earnings per share amount for this company as opposed to the elevated earnings per share, which is what the price to earnings is reflecting right now. And so, you know, when you see a low price to earnings ratio, oftentimes it signals the opposite of what you think it would signal, which is that the earnings might fall off. So it's something very important to take into consideration. And it's one of those things that you will investigate and understand as you model out the company, because you'll see what's sustainable and what's not. The second ratio is the PEG ratio. Now, this is a ratio. Now, I'm not sure. You guys let me know, but I'm pretty sure this was popularized by Peter Lynch. Now, if you guys are looking for books to read when it comes to investing, you know, when I started my investment journey about 20 years ago, it was the Peter Lynch books that I started with. So look for anything written by Peter Lynch, and that's a really good place to start. But, you know, when it comes to the PEG ratio, I always ask what time period was used. And so let's get into that. So the PEG ratio is the price to earnings ratio that we just covered divided by the average earnings growth rate of the company. So not actually the growth rate of the stock price, but what they mean by that is the growth rate of the earnings. So the E portion of the PE. So if you have a number that's lower than 0, you have a really good PEG ratio. In fact, closer to the lower the better would be what you're going after with the PEG ratio. But my challenge here is, and the question I always ask is, what time period was used for the growth rate? Because the growth rate for the earnings typically slows down as the company matures. So if your company had just recently had an exceptional 4 or 5 years of growth, and that's what's being factored in or calculated into your PEG ratio, the question I have is that growth sustainable? Will you achieve that same level of growth in the future? And so what I say is it's better to calculate your own PEG ratio using expected future growth, because at the end of the day, growth acts like an anchor. It will slow down as time goes on. And so, one of the mistakes a lot of people make, especially with high growth tech companies, is they'll forecast out that growth into perpetuity or for a very long time. And then they get surprised when the growth slows down. And so you have to be very careful. And so once again, a PEG ratio isn't a be all end all. It could once again signal a value trap where the market is suggesting that the growth is not going to be growing as fast, or the company's not going to be growing its earnings as fast as it has historically. And so you have to be very careful. And so again, I'm sort of like saying the same thing over and over again, but the PEG ratio is something that you start your analysis of the company with. It's not the ending point. Finally, with price to book, this is one where, you'll see a lot of investors say, hey, the company's trading under its book value or close to its book value. And that doesn't mean a whole lot to me. A company can trade under its book value if, especially in a situation where the company's experiencing trouble or the company's a very risky business by its nature, and it could be destroying some shareholder value. And so, I put the point here that oftentimes the companies that investors use price to book ratios have a lot of leverage or inherently risky. And so, the first question I'd ask is, what is the average return on equity for the company, and how much leverage does it have? So if you compare the return on equity, the average ROE, and the average ROA, if there's a huge discrepancy between the two, you might have a company that has a lot of leverage, and so that company has a lot of risk. So be careful for that. And I just put in 2 types of companies that people do use price to books to value. So if it's a bank, the first question I'd ask is, who are they lending to? Are they more consumer? Are they more corporate based, like industry based? And then what industry are they typically lending out to? If it's a cyclical industry, be very careful. And so what does their loan loss look like, and where is it trending? So if they're loaning out to consumers, and a lot of consumers are defaulting right now, people are losing their jobs, et cetera, then you could see this loan loss rate trending. And with banks, the losses can add up very quickly. Just ask anybody who was invested in banks in 2007, and they held on to those by 2009, right? This gets really bad. If it's an insurance company, ask yourself, is it long or short tail coverage? And so the difference between long and short tail coverage is that it might take decades for the losses to occur. So for example, like medical malpractice might be a long tail coverage, whereas a short tail coverage might be auto insurance. So you got to understand this if you're going to invest in insurance companies. Don't just buy up insurance companies that have low price to book ratios. And then ask yourself, what does the combined ratio look like on average over the past 10 years? Is the company just showing very low combined ratios right now, but it's going to revert into the future? And ask yourself, where are they making their money from? Are they making their money from good underwriting, or are they making their money from investments? And how will that trend continue into the future? So with all of those questions, you still have to end up going back to the original place where I told you to go, which is that you have to go in and value the company by building out a model, understanding the whole story, and then determining if you're going to invest in it. So once again, even with price to book, you really have to understand the story. Don't just buy these companies nilly-willy by saying, oh, it's trading at under book, it must be cheap. once again, it could be a value trap, so be careful. And I know a lot of you guys like to screen companies using these multiples or these value gauges. And so what I did was I actually I ran a screener on Seeking Alpha just to sort of give you guys an explanation of the shortcomings of using this type of strategy. So once again, I say I use valuation multiples to start my research and identify potential opportunities, but this is not the only way that I try and identify opportunities, but that'll be another video where I show you guys how I identify opportunities. But you can see that what I did is I ran this screener for just some large companies, and I just wanted to see what they look under the valuation metrics. And then I just said, any company that has 3 or more valuation metrics where they're somewhat cheap, like under 10 or under 15, I'll highlight. So notice with JPM, their price to forward earnings ratio is under 15 times. Their price to book is under 2, so that's really good. And then their price to cash flow is under 15 times, so that's really good. So I put a red box around it. Same with CVX, and then these other 3 names here. But the thing that I want to point out to you is if you're just looking at this list and looking for low metrics, you're going to miss certain things. Like, for example, we all know, if you follow this channel, that Google or Alphabet right now and Microsoft are trading under, not over, but under their intrinsic values. However, if you just use this screener, you'll say, oh, their price to earnings are somewhat high, their PEG ratios, they're under 2, so that's okay, but not super low either. And their price to cash flow is somewhat high. For Google, it's under 15, but for Microsoft, it's over 20. And so you'd probably argue that maybe it's not worth it to look at these names. Let's look at these names first. And you would be making a mistake, at least in my opinion, because these are world-class companies that you're ignoring in this particular screen. And so be careful. But I do want to take a company at the very top, so like Apple, which is one that we all understand, and just walk you guys through how I would sort of like take a look at what the company has done in the past and sort of how I would value that out. So here's Apple, right? I just picked Apple just because everybody knows the company. And essentially what I do is, like, once I pick a security to analyze, I try and understand as much about the company as I can and forecast out earnings as granularly as possible. And you guys have seen me do that on this channel a lot. And so what I'll do is I'll try to understand each of their segments. And so they segment out their business by product. And so, I try and understand, what are the economics of the iPhone? What are the economics of the MacBook? What are the economics of the iPad? What are the economics of their wearables and home accessories? And what are the economics of their services businesses? All of these products have different economics. And so they will grow at different rates, and you kind of have to understand that. And you can see just from here, this is just the historical numbers, which is part of the trackers that you guys can get access to. I've already built this out. Notice that the overall revenue has been growing in, like, essentially at that single digits, except for 2021, where I think you had a catch-up purchase. But notice that the wearables have been growing fast, and the services have been growing fast. And the iPhone has kind of been growing fast, but not as much. And if you did a CAGR, the iPhone doubled from 100 billion to 205 billion, but notice that the services went up 10 times from 8 billion to 78 billion. So the question I have right away when looking at this is, would services continue its high level of growth? And is the iPhone slowing? Because it has doubled, but even notice just from 2015 to 2016, it actually declined, and then it didn't come back over the 2015 number until 2018, and then it declined again, and it only came over that 155 in 2021. So how do I think about growth with the iPhone? Should I actually be reducing that closer to that 175 area from 2022? So those are the questions that I would encourage you guys to ask, and that's the sort of like level of granular detail that you'd want to use to forecast out these businesses. And unfortunately, just looking at valuation multiples will not give you the answer. However, I do have a shortcut for you guys. This shortcut takes time to build, but once you get to it, you do have somewhat of a shortcut when it comes to determining stocks to invest in. And here's a shortcut that I use for myself. What I have done is, over time, as I valued, hundreds of companies, I've placed them on this tracker. And what the tracker does is I've granularly built up the valuation or the intrinsic value, like what I think these companies are intrinsically valued at. And then I just wait, right? And every day the stock market provides me with a different price. And every day I decide whether or not I want to invest in the company. And so, you know, you guys see me spend a lot of time talking about Alibaba. Well, at the time of this video's recording, you can see that Alibaba was trading at $88 per share. I actually had entered into Alibaba and like a year ago. And then, you know, when the share price went in that like $70 per share, maybe like low 80s, I can't remember exactly where, I actually used this tracker to determine that it was trading at approximately 35% of its intrinsic value. And so I doubled down. And I will continue to do that type of analysis. So every day at around noon, when I'm eating my lunch, I open up the tracker, I look at it, I see if there's any like crazy, interesting opportunities. You know, I'll look at like the plus and minus for the day and determine if the stock has gone down considerably. Maybe there's something to look into, something has happened. But, you know, I use the tracker to determine if the company's cheap because I've already spent the time to determine its intrinsic value. And I keep that up to date at least annually. So you can see like the last time I updated the model, you see it's December of 2022. Then there's November of 2022 and September and then November. So, you know, I try and keep these things up to date. I look at them at least annually. And so I have somewhat, not exactly, but somewhat of an idea that this intrinsic value calculation is correct. And so then I just gauge whether or not the price is worth paying for this particular security. Now, you guys, I highly encourage you guys to build your own trackers. I think it's very important because you really have to figure out what the intrinsic value of the company is for yourself. However, if you want to kind of learn how to build the trackers and want to have access to a tracker that you can sort of like bounce what you think the company's worth against what I think the company's particularly worth, well, you can get access to that, all of that at the lower tier of the Patreon. And if you want to join us for an epic live presentation where I sort of like interpret the tracker, I give you the deep understandings of the stories behind the numbers, you can join us at that higher tier. And so once again, the moral of the story really is when it comes to valuation multiples, it should begin your journey into analyzing the company. It shouldn't be what you base your investment decision on. At least that's my opinion. I want to know what you guys think. Now, because this is the Q&A series, if you've missed a previous Q&A video, you can actually click right here for another awesome video.